Welcome to the Stash Cast, where innovation meets real estate. Let's dive in.
Ryan, thank you so much for coming back, and you're my first repeat guest.
Oh,
Cheers
all
to you.
right,
You
all right.
I should put a crown on you or something.
No, it was great to be here the last time. I think there's a lot that has changed, obviously, since then. And, me, I could talk for hours about the market. So it's good to be back here to talk with you.
Yeah, and you're a handsome guy. That's not a terrible thing, and you know how to have a conversation. That's good. So, I guess last time we spoke was it was May, or I put it out in May of last year, so it's probably like right before that. And we were almost halfway through the beginning of 2024. How did 2024 end up for you and Stonebag?
Yeah, probably the same as a lot of other groups, which was a lot of underwriting, a lot of deal sourcing, not a lot of transacting
At all.
So at all. Again, that's not for a lack of want to. It's just that there's such a dislocation in the market for a lot of groups at the moment. Us, Stoneveg being one of them, where there's a certain return threshold that we like to underwrite, obviously, and a yield on cost that makes sense to us. And we typically underwrite to usually a 5-year hold. And what you're seeing out there is obviously lack of deal flow, right? There's not a lot of deals that check the boxes for us. And what we look at is essentially 2000s and newer products, breakpoint, all the way up to pre-stabilized. And obviously in good submarkets within the Midwest region, Southeast, Southwest, and you're just not seeing a lot of that come out at a price that really makes sense for us. It does make sense for some groups, and those groups would be large private offices, discretionary funds with a large amount of capital sitting on the sidelines, wanting to be deployed, underwriting maybe 7-10-year hold, lower IRR, but looking at the changes that they expect in the macros over the next 24 months. So what I mean by that is that these groups, they're looking at as 10-year hold. Yes, right now, market fundamentals aren't very strong in a lot of these major markets. You've seen a record amount of supply. You've seen some softening in rent growth, certainly because of that. Net migration to some of these areas, while is still pretty strong, has slowed a little bit. You're still getting good absorption, but you're just not seeing the strong market fundamentals that you need to really underwrite rent growth of, say, 3 or 4% over the next couple of years. So you have to buy and sit and wait for those fundamentals to improve before you really start to hit your return thresholds. And if you're doing a 5-year return, that's putting you 18 months, 24 months in the hole. Well, 36 months is not enough time to make up that ground, to really blend that cash on cash. Even if you get a year 4 or 5 cash on cash of 8%, it's not going to offset the minimal cash flow in the first couple of years. Whereas if you do a 7 or 10-year hold, then yes. And that's what you're seeing from a lot of these buyers are saying, look, we like the basis. We like the real estate. Sure, the market isn't very good right now, but we will basically hold our nose for the next 18, 20, 24 months. When the construction pipeline really starts to drop off, these markets that we're in are going to start to see really strong fundamentals come roaring back later 2026 into 2027. And then we will be positioned with a real estate buy at a good basis to start making some real money on the back end. And that's outer years, 5, 6, 7, 8. And so that's the way that these groups are looking at it. And that's how they're getting these transactions completed. And again, that's what you're seeing really across the entire landscape, at least the markets that we cover at Stone.
Yeah, I think I saw something that overall transaction volume across the country was down 40%.
Yep.
Last year as compared to the height. And I know for us, we managed through, but it was a lot of what essentially amounted to busy work. Now, you didn't think of it at the time as that. If you look back, that's what it was. Now we just can't bridge that gap. And I think with certainly the election, whether you like the outcome or not, that gave a stability to the market. So you at least know what you're going to have for the next 4 years. And there's been the treasury has calmed down.
Yeah, the 10-year being, I think it was at 4.25 the last I looked at it. So It's down today. All eyes are looking to Wednesday when basically the broad-based tariffs from the Trump administration is supposed to be put into effect. Now, obviously, there's been a lot of back and forth from the administration as to who they're going to tariff, what they're going to tariff, when that's going to take effect. And you've seen a little bit of a ping pong of the
Yeah.
market as people try to figure that out. What's the long-term impact of what the Trump administration wants to do here over the next 3 to 4 months? You talked about busy work. For us, when it came to underwriting deals, we'd continue to underwrite everything that crossed our inbox with the goal of trying to find something, that diamond in the rough, or something that kind of stood out, but really in that type of asset class, in that B plus, A minus asset class, a core plus space that we like to operate in, it was really pretty similar across the board. We'd see assets, especially in the newer construction, where they couldn't get stabilized without having to increase the concessions, or you're seeing just constant vacancy at 8, 9, 10%. So your economic occupancy, when you layer in the concessions and vacancy, and maybe in some of these markets, bad debt, you're talking about 85% economic occupancy. You can't underwrite taking over an asset and then collapsing all that within a month or so. You got to burn off the concession. You got to allow for the vacancy to decrease. And again, you just simply, any smart buyer is simply they're going to underwrite 12 to 24 months of being able to achieve that.
Right.
And again, that's why you've just seen this dislocation and the lack of transactions. One of the things that I saw back at the National Multifamily Housing Conference in January was a collective pivot from a lot of groups from that 70s, 80s value add type of asset profile to what we look at. And we made that pivot 2 years ago. So we were looking at a 1970s vintage, 1980s vintage, and we have a good bulk of that in our portfolio now. And we said, you know what? It's just getting too frothy. The juice isn't worth the squeeze. The amount of capital that you have to outlay to ensure that you have enough money there to adjust deferred maintenance to execute the business plan, it's just not worth the returns that we were underwriting. And we completely pivoted out of that space. And I think what you're seeing now is a lot of groups have taken that same approach. And that's really had a massive impact on that kind of B minus to C class space, that especially the 70s vintage and older. You've seen the buyer pool dry up there because, again, the juice isn't there. And I think a lot of groups have come to that realization. And so now I describe this market as the haves and the have-nots. When it comes to the buyers, you have the buyers that have and the buyers that have not. If you have a well-located 90s, 2000s, 2010s vintage asset in a good submarket that has relatively strong performance, you're seeing 40, 50, 60 bids, 100, 200 signed. And then you have a 70s vintage product and maybe not a great submarket getting 20 offers maybe total, maybe 30 or 40 signed CAs. And so you just have this bifurcation in both the buyer pool and the assets that are being offered. And that's what you're seeing right now is everyone has shifted and flooded into that 2000 and newer space and has moved out and cycled out of that 70s, 80s stuff. Now, do I think you see a cycle back into the 70s and 80s stuff? If it's well constructed, yes. If it's been maintained, yes. If the returns make sense, that even if there's deferred maintenance and you got to pump a lot of capital into it, is the juice worth the squeeze? Then yes, I think you see buyers pivot back into that space. But right now, again, you saw a lot of groups buy that kind of vintage for a hefty per door price in that 2001 or 2021, 2022 run up. And you got to have to move through the cycle with all those deals and get them resold or taken back by the bank. Yeah, they have to be repriced. And until that happens, we've talked about the extend and pretend and all of that's going on, and you continue to see that. And that leads me into really the election and what the next couple of months looks like. And I really do think that right now it's almost like we're in the inflection point of the Trump administration as far as to how is it going to affect our industry over the next 6, 12, 24 months. And again, it all goes back to the tariffs, the impact that the tariffs have. If you listen to Trump, if you listen to the Secretary of the Treasury, Scott Bessent, if you listen to the Commerce Secretary, Howard Lutnick, they all are saying the same thing. There's going to be short-term pain for long-term gain. Again, you can look at Paul Volcker in the early 80s. He took the same approach. He moved the Fed fund rate up and basically snapped the economy after the Jimmy Carter years. And there was a good 8 or 9, 10 months of pretty strong pain. But then the economy came back and roared back really through the entire 2 years of the Reagan administration. And I think they're looking at that and taking the same approach. Hey, we are willing to have this happen. They want to get the 10-year treasury yield down. They want to get the 5-year down, and they think this is how they can achieve that. Now, obviously, the issue they run into with the tariffs and the policy they have in place is that they got to get it started and done sooner or later, because then you start to run into the midterms. People are going to have that fresh head there, and it could affect, obviously, the midterms for the Republicans. And then also, a lot of people don't quite understand tariffs outside of maybe what they hear on the news. And if you look at the polling, it's not a very popular strategy amongst the electorate. The general population of the voting bloc, not a big fan of tariffs and what they could possibly do and the impact that they will have. If you were to ask me my opinion on the tariffs, it's hard to give you one, because I just don't know, and nobody knows what are they going to end up tariffing on Wednesday. How's it going to impact? How long are they going to have the tariffs on? We just don't know any of that yet.
Yeah, I talked to an appraiser who trying to get some comp information, and that was one of his questions. If it were to sell today with the tariffs not in place but looming, do you think that would have had a negative effect? I think it'll mostly affect new development. I think that is going to continue to compress that supply pipeline of new construction, which it will restrict the supply of new housing coming on. The demand is still there, which is going to cause prices to continue to increase, both on existing assets as well as rental rates as well. But on the flip side, there was an example in Indiana where Honda was going to build a new Honda Civic plant in Mexico. And then they heard of the tariffs and they said, we're going to build it in Indiana. And so I think that is what he's driving at, is trying to onshore jobs here. And I think that's what he's also trying to do with saying, hey, you'll be able to deduct the interest from your car payment if it's made in America. So I think the point of that is it's not an American made, it's not an American company, just if it's made in America. And I think that those are strong things. And then I'm a big fan of what Elon Musk is doing, eliminating all this waste. And so I think if you can combine that and then maybe even restructure the tax code, I think that would have some meaningful change and impact. But I'm also out of my depth here too.
The Stash Cast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions? With Needle, you can. Check it out at needle.us to learn more.
I agree. It's just, you can argue about the way they're going about it and the kind of the in-your-face approach that Elon Musk has taken. He's out there with the chainsaw and things of that nature. And you're talking about people's livelihoods that are being affected, and that shouldn't be lost on anybody. But at the same time, if you take just a cursory glance at the government and the amount of spending involved, and I know people in the government, I've been closely connected to it. So I've been told, hey, Brian, listen about this case of fraud and abuse in the government. And so it's certainly a thing. How big of a thing, we're still finding out. That's where we are overall. And I agree with you. Yes, the Trump administration is trying to bring jobs back to the U.S. It's trying to increase the manufacturing base that's really been lost to other countries over the last 30, 40 years. And obviously, I look at tariffs as a consumption tax. You only have a finite amount of consumer capital, right? And so if prices of things raise, consumers will change their purchasing preferences based on what may be cheaper. But again, they're not going to be able to just take in all the price increases across the board. That's why if you listen to Jerome Powell, when he spoke at the FOMC, he said that they believe tariffs are a transitory part of inflation. And I can't say I would disagree with that. Now, again, we'll see what the Trump administration does as far as the amount of tariffs they implement, how broad they are. We still don't know that. But Yeah, if you look at what they say and what they want to do, they want to bring jobs back to the United States. And sure, things may cost they may be more expensive in the interim, but they want to change the tax code to give a tax break and basically decrease everyone's taxes to offset what they may be charged in the short
Right.
term for goods with the tariffs on top of that. Yeah, obviously we could get into the minutia of it all, but I like the fact that at least something is being addressed, right?
Yeah.
They're trying to address it. If you take a look at government spending, you take a look at the deficit, none of that was sustainable long term. One thing I will say, I will disagree with Elon Musk on is he talks about the government being a business, and you don't operate it like a business because it's the government and it's just two different entities. You can run a deficit in the government and you can spend more than you take in as long as the system continues to operate efficiently and you don't see the debt kind of spiral out of control. You still got to be mindful of your debts. You still got to understand the system that you're in, but that doesn't mean you have to save money and run a budget surplus. It's just almost impossible again at this stage in the country's history anyway. But again, you could cut out billions upon billions of dollars that looks to be going to programs that I wouldn't say are critical to our nation's infrastructure.
Yeah, they're not core. Can we get some better roads? You're in Tampa. I don't know what the roads are like down there, but I'm here in Cincinnati, and it's every time I hit one of these potholes, it's just so painful.
It's funny you say that because the roads here in Tampa are actually pretty good, but I took a side street last week and I did hit a pothole going 20 miles an hour and blew the tire out in my car and had to have it towed to the dealership. Every once in a while, you run into some bad roads down here, but yeah, obviously, infrastructure is a massive part of the country's growth and be able to sustain that growth. I'm from West Virginia. And one of the reasons West Virginia is stuck in no man's land, is squished in between Virginia and Ohio, which have pretty strong booming economies, is that the West Virginia is full of mountains. And it's just hard to have good infrastructure when you have such topography. And when you don't have good infrastructure, it's hard for businesses to want to do business there and to attract new businesses. And you use that as an allegory for the rest of the country. Yeah, you got to have good infrastructure. That's obviously a key point of having a healthy country and a healthy economy.
Yeah, you talking about roads and infrastructure. I think you've got to ensure that the vehicles that are traveling over the roads or the bridges are not going to be damaged or in danger of a bridge collapsing.
Baltimore.
Yeah, that one got hit
Sound-
by a barge, but
yeah.
there was one, I think it was in Minneapolis a couple of years ago. It was like 30 years past its useful life, and they had just been holding it together. And then finally one day during rush hour, it just collapsed. And it's like, how many other bridges are like that? Like we have the Brent Spence Bridge here, which is right next to one of your deals here in town. And it's like there's always a bottleneck of traffic going over that at any time of the day, virtually. And a lot of the bridges are functionally obsolete and they hold them together, but
Tampa is a good example. We just opened the Howard Franklin Bridge. The initial bridge over the bay was built in the 1960s, the eastern bound lanes, and then the western bound lanes came after. Now they've just built a brand new bridge across that is actually the largest bridge by square footage in the state of Florida. Beautiful, but very badly needed. It's the main thoroughfare from Tampa to St. Petersburg and just gets bogged down with traffic every day. And things like that make a world of difference. Tampa, if you look at the population growth that this area has seen, it's been over 100,000 people that have moved to the area in just the last couple of years. And you feel it, like it's visceral. You see it, you feel it, you sit in the traffic that used to only take you a half hour to get somewhere, and now it takes you an hour. And so you know that you got to see these infrastructure improvements to, again, be able to handle the growth and to allow for a city to breathe and to really expand. And yeah, I agree. It's certainly government should have a big focus on infrastructure going forward.
you mentioned earlier about some of the markets you're looking at or maybe also in performing better than others. I'm curious, the past 2, maybe 3 years at NMHC, certainly 2, seems like the Midwestern markets are more popular or in vogue. What do you see as the differences between those that are performing better from your position and those that are suffering a little bit?
Yeah, it all comes down to the construction supply pipeline. If a market has a massive construction supply pipeline, say in Austin, Phoenix, Charlotte, Raleigh, and Nashville, you're not seeing a lot trade. You could go back to almost 3 years and you're just not seeing deals trade in these markets. Same with Raleigh. Charlotte maybe was a little bit more active, but that's probably more in the suburbs, northern suburbs of Charlotte. Whereas, yeah, the Midwest, you just you didn't see that construction boom that you saw in the Southeast and the Southwest. And so I was just able to handle I should say, I guess, the change in the market better, as far as you didn't have a lot of new supply come in where you just didn't have the people moving to the area. And so what I mean by that is that we've always liked the Midwest because it's more predictable, is the best way to put it. You're not going to have the highs and the lows, but as long as you got steady growth in most of those markets, they see pretty steady population growth, nothing that's going to knock your socks off, but they are seeing growth from other states, say a Michigan or a Minnesota or Wisconsin or an Illinois moving into an Indianapolis or over to Kansas City. You're still seeing that with a limited amount of new supply when compared to some of the other Sunbelt markets. Now, I'll say that with the follow-up being that there are some groups that say, look, our buying window in the Midwest it's closing, right? Because now the Southeast has been getting pummeled for 2 or 3 years. The construction supply is going to start to fall off. The pipeline is going to get thinner, and we're going to start to see strong fundamentals come back to these markets. So why would I buy in a Midwest market now when I could buy in the Southeast market where I'm more bullish long term, where I think I can get a little bit more yield here long term than say a Midwest? And I'm not saying I prescribe to that. I think that the Cincinnatis, the Columbuses, the Kansas Cities, the Indies that we're in, I think there are good buys to be had. I think there's strong markets to ignore the middle of the country. And again, having strong infrastructure in place in a lot of those markets, I think is not something that we would want to do. We would want to stay involved in those Midwestern markets alongside investing in the Southeast and Southwest.
Yeah, the Midwestern markets are predictable. We've seen consistent rent growth here month over month, quarter over quarter, while other markets like in the Sunbelt have gotten maybe stalled in rent growth, if not seen some retraction. I've heard markets like Phoenix, for instance, you've got developers either having to do a cash in refi, or once it's up and out of the ground, it's worth less than what they have into it.
Mm-hmm.
That's a tough position, but that's a result of all that oversupply that comes on.
Yeah, you touched on a good point. There's a lot of deals out there, especially in the Southeast and the Southwest, that were bought at a massively high basis, and equity has been marked down 50, 60%, maybe 70, 80% in some cases. These guys, these owners, they will continue to hold on as long as they're allowed to. That's what's gummed up the market for so long, is that there's just not a lot of market sellers out there. Yeah, if you bought in 2017, 2018, you're probably going to do a 2x on your money. But if you bought 6 months after COVID all the way up to the beginning of 2023, you got to wait a while. And we're all playing this waiting game with the transaction account through the first quarter of this year. As we sit here on March 31st, it remains muted. If I talk to brokers on all these markets all the time, it's really everyone just sitting and waiting. I think we're all tired of that. It's been a long couple of years of doing that, but that's where we continue to sit. What gets transactions going again is when you start to see stronger fundamentals return, and you can underwrite a deal that's at 92% or 93% occupied and feel good about not having to underwrite any concessions and being able to underwrite 3% rent growth. And you talked about some of these markets stalling out in terms of rent growth. A lot of them have been negative rent growth for 6 to 8 quarters. Now, if you take a look at any of the analytic platforms, RealPage, CoStar, those analytic platforms really start to show rent growth kind of start to return in Q3 of this year and really start to pick up in Q4 and Q1 of next year. And if that ends up being the case, obviously that's going to start to bring more transactions back to the market. But at the same time, we all watch the Treasury yields, hoping for the yield to go down. And we've seen a little bit of that happen. Obviously, as I mentioned before, the Trump administration really wants to see that 10-year yield lower. Certainly, if it were to get somewhere around 4%, yeah, that would certainly open up things more as well. But again, as I mentioned earlier, in that core plus 2000s and newer space, cap rates have remained very sticky. No matter where the treasury goes, usually the cap rate moves with the treasury. You have not seen that. Cap rates have remained very sticky in most cases, maybe at best a 5.1, 5.2, stabilizing to a 5.5, 5.6. But for some of these deals, you're still talking 4.8, 4.7, 4.6 cap. And again, it goes back to my haves and the have-nots. Are you willing to stomach negative leverage for maybe a year or a year and a half? If you're not, you can't do anything. You have to be able to justify a 7 and 10-year hold and justify really making up your returns on the back end of the hold period, because groups are doing that for well-located real estate with sound fundamentals that's maybe insulated from construction supply, or maybe they're just really bullish on the submarket. But again, those buys they don't happen very often. It's just not a lot out there that makes that kind of sense. And yeah, it's going to take some unwinding of what happened in 21, 22. And again, as we mentioned, kind of a new round of pricing discovery. And we just still haven't had that yet. It's just not been enough deals out there priced to where the majority of groups where they can underwrite returns to today. So you're just stuck in this quagmire. I write about it every week, and I'm tired of being redundant about it, how we're all just sitting and waiting and everybody's in limbo. But that's just where we are. Because again, at the end of the day, as fiduciaries to other people's money, it's better to make no deal than make a bad deal. We don't know what the impact of the tariffs are going to be. We don't know, maybe the economy goes into recession and there's been indicators and you see the chances of recession forecasts bounce up and down. And so you just say, you know what? And this is where we've been for the last couple of years. Let's just continue to follow the market, understand what's going on. But unless a deal makes sense for us, let's go ahead and bite our tongue and put our pencils down. And that's what we've done. And that's what a lot of groups have done, which is, it's good. You don't want to see people out there just saying, hey, you know what, we got money, we're going to spend it. We want to do the right thing by our investors.
As you were speaking, an analogy kind of came to my head of, so if you've ever been at a bonfire, right, or you've had a campfire or something, and you pour lighter fluid on it, the flame is just going to explode. And then that is basically what happened when they dropped rates to close to zero. And that was the asset prices going up. And now we've seen that has burned off and they're trying to tame that down. And it's just the same thing. Or if you put a bunch of paper on fire, I grew up with a wood stove. So that's how we heated our home. And so if you put a bunch of paper in there, it'll go up real fast and real quick, but then there's nothing left to it. And we're in that after effect. And we saw it in our BOV pipeline, like we would have spreads as high as 30, 40% based on what we thought we could achieve in the market at the time and the owner's pricing expectations. It has since come back, and I think we've year to date, we've had I think a landslide closing today. Things are finally getting back to normal. And I think we'll see that progress through the rest of the year. But since you're in a unique position, because you're talking to guys like me all over the country, the front end of our pipeline is pretty thick. Are you hearing that same thing from other brokers? And then my follow-up to that is, what do the best brokers do that you've seen? What makes a successful broker in your mind?
The brokers I've talked to, similar to what you mentioned, just so many BOVs, BOV after BOV, and a lot of groups, again, on that fence. So you talk about lighting a bonfire and it igniting. There could be a movement that precipitates that. If rent growth and if fundamentals start to come back, you may see a lot of these groups that have gotten BOVs say, all right, now it's time to go. And maybe you see a lot of deals all flood the market at once. And that's been the feedback really, is that, yeah, we're doing a lot of BOVs, updating BOVs, keeping sellers apprised of where we think we can get value, but really a lot of fence sitting. But obviously when it comes to brokers, at least for me, when it comes to listing stuff, because we've had some stuff out there in the market recently for sale across the United States. And just, for example, when it comes to getting to BOV, I always tend to look at what have they done in the market? What are their connections to the buyer pool that we would want to attract? What are their experiences? Because we have certain different assets and certain different asset classes. And so we want to make sure we're getting the broker the right broker for that right asset. So if we got a B class asset somewhere and we got a C class asset somewhere, they may require two different types of brokerage houses, depending on what they specialize in. That's essentially where we start. And then really, for me, it's, are they underwriting the asset the way that I would underwrite the asset? And typically, I will do an underwriting myself and value it based on certain parameters. And then I want to see if they're going to do things a similar way. And then obviously, for me, it comes down a little bit to want to. And I'm not saying I need to be flattered, but I want to know that my business matters a lot. That's just the way I'm wired. I want to know that, all right, we're locked in on trying to win your business. We want to win your business. What's it going to take to win your business? What can we do additionally to win your business? I like those kind of questions because that tells me that they're going to go out and do the same thing when it hits the market. And obviously, for me, when it comes to the BOV, I want to see a price that I think is realistic, not so much pie in the sky just to win the listing. Because again, I've either already underwritten it or our asset management team has an in-house appraisal on it. So we already know where we stand on valuation.
Yeah.
So are you going to try to pull the wool over my eyes by giving me this pie in the sky number? Or are you going to give things to me realistically? Because that's what I don't want the BS. I want to be told, this is what we think we can get in the open market. And we're going to do everything we can to try to achieve this number. And so for me, that's what separates some brokers from others. They want my business. They want this asset because they know that they can take it to the market and get it sold for the price that we need.
Yeah, that makes a lot of sense. You can't ever take anything for granted, even if you happen to be the market leader. It's when you're at the top of the heap, you've got to keep doing everything that you've done to stay at that top of the heap. And I guess it's only when you take your eye off the ball is when things come to bite you.
Yeah, obviously, the brokerage side of things, we talked about this in the past. I don't think I could do your job just because it can be cutthroat. And candidly, I'd love to be able to give all the business to every broker that I talk to because I have a good relationship with, I think, with basically all the brokers that I talk to across the Southeast. At the end of the day, it is business. And for me, I'm going to go with who I think is probably not only can get it sold, but again, shows the most desire and most want to. And especially in this environment where I think we're all wanting more business than what we have, some of those things can end up making a difference.
Yeah, I just had the first experience of my life where I was on the other side of the table. So I'm doing this a 6-unit development, and I treated it just like I'm doing a call for offers process. So I had a couple of different vendors, and I had them go through a couple of rounds of questions and bids. One group down for the cabinets and countertops, and I wanted to give it to both groups, but you just can't. Unfortunately, business is a zero-sum game in our business, especially such. One of the things I've always done is ask for feedback. Okay, you can't get butthurt about it. You just have to be like, all right, why did I lose? And hopefully the person on the other side is willing to give you that feedback. And then you have to be able to take it in and adjust for the next time.
Over the years, how many times I've been in a best and final or a top 2 or top 3 and got told no. More times than I could ever want to count. I always tell people I'm in the business of getting told no. Yeah, we both are. It's just part of it. And of course, getting told no 1,000 times and then you get that one yes, it makes that one yes so much sweeter because you're like, yes, I'm getting a deal done. And it allows for you to appreciate the wins much more than maybe other industries because you don't have them as frequently as you would maybe in other industries.
For sure. Yeah, it's not like our deal cycle is 30 days. We're
Right.
selling cars. We come in and have a sale within 4 hours or something. It's a different thing to ask you. How do you feel like the rest of the year is going to shake out?
Yeah, we're talking about NMAC and 2023. Everybody was like, this is going to be a very good year because they had just raised the Fed fund rate and kind of turned deal flow off. But yeah, you still saw a little bit of optimism, which wasn't warranted, obviously. And then 2024 was like, yeah, we're going to get back to doing deals this year. More optimism in 2023 still didn't materialize. And I think at this year's conference, you saw a little bit more muted optimism. It's like, all right, we've done this song and dance for 2 years. The market still hasn't really opened back up. We're still in this down cycle, or whatever you want to call it. So it's probably going to be the first half of the year is going to be slow, but things will start to pick up. And everybody points to the construction supply pipeline falling off cliff. And for good reason. Obviously, it's supply demand. And as long as you continue to see strong demand in some of these markets, which you do, things should pick back up. But again, for me, I really want to see 2 more months of inflation data. They got a jobs report at the end of this week. Again, we talked about the tariffs that are going to be rolled out on Wednesday and what the impact that has. Don't know what to expect the rest of the year yet. As you may know, I'm a junkie for data and economic data, and I like to parse through it all. One thing that really stood out to me is that roughly 50% of consumer spending is done by the top 5% of earners. And so you have 90 to 95% of the consumer is accounting for their 50% of consumer spending. As I've said for a long time, this economic recovery and economy in general has been bifurcated. Again, the haves and the have-nots. You have the haves that have gotten wealthier, that spend money, that go on trips, that buy cars, and then you have the bottom half of the country that's really just piecemeal, putting things together, moving along, but not really getting ahead. And again, I think this kind of goes back to what the Trump administration wants to do, is reinforce the middle class, because you are seeing that bifurcation. And then you take a look at like student loan borrowing, as that has resumed, the amount of people that are already defaulting on that debt there. You just see these little cracks here and there. Does it open up into a giant void? I don't know yet. You're seeing border crossings basically drop to zero, more or less, simply 100s. How does this all kind of mesh together and affect the economy as a whole in the interim? How long is it going to take for Trump and Doge and the administration to implement everything they want to implement, the change that's going to bring, and moving forward from there as far as bringing manufacturing back to the United States? Nobody really knows. Nobody can tell you what's going to happen. There's not really any precedent for what we're going through. People will look back at the 1930s and the broad-based tariffs that we did then, comparing the United States and Europe from the 30s to the United States and Europe and the rest of the world today is just nonsense. You can't do it. The United States was not the economic power and the leader of the free world in the 30s that it is today. And so we really do have more leverage than, say, a Canada or Mexico or the EU. We can sustain whatever short-term economic pain may be coming because of the implementation of tariffs. And so that's one thing that we have going for us. It's just a matter of how much pain is the Trump administration willing to put up with before maybe they pull back a little bit. How much negative press will this policy continue to have? Because you are seeing, again, polling numbers soften when it comes to Trump's economic plan. And so that's just stuff that you really got to continue to wait to see before you start to feel good about making investments at the moment. And again, I think you're seeing that in the market. It's been sideways here for a while. You're seeing that in the multifamily market, same thing there. You're just not seeing a lot of deals get done. And I think that's going to be the trend that we're on, at least probably till midpoint of the year. And then I think back half of the year, assuming that everything smooths out a little bit, if the treasuries come down, I think you're going to see people start to invest again and really want to pick up good quality real estate. I think you're going to see groups say, all right, we've held on for long enough. We bought in 2021. Let's take a small loss and move on. And again, that kind of usually leads to pricing discovery in itself and jumpstart the market again. Hopefully, it's just been a lot of hope in this business over the last 2 or 3 years with not a lot of payoff. So it's got to change at some point. It can't last this way forever, whether we get there through incremental changes in fundamentals and the treasury rates, or a large change in the economy in general in terms of a recession that kind of resets pricing. One way or another, we're going to get there. And then again, the multifamily fundamentals in 26, 27, 28, I'm very bullish on long term. We just got to continue to work through this uncertainty over the next, again, hopefully only 3 or 4 months.
You said that you guys, or Stonebag or other investors maybe, have, say, a given hold period that you underwrite to. And I wonder what you do when, okay, we're at year 5 and it's mid 2024. Do you just kick the can and say, you know what, this is not a great market to be selling into? Or is it, that was the prescribed exit, we're going to proceed according to plan?
Yeah, it would depend on when you set your balloon payment, right? So if you do a 5-year hold with a 5-year balloon,
You have to.
yeah, you're going to be in some trouble unless you're going to do a cash-in refi, which typically would require a capital call, which nobody wants to have that discussion. You may start to see that next year if you bought on a 5-year hold and you're saying, you know what, the loan's coming to term, let's go ahead and just sell and take a little bit of a loss. But yeah, if you're on 7-year debt and you can afford to maybe hold on to it for a couple more years and wait for the economy to get a little better. But again, if you bought in 2018 with 7-year debt and say, obviously it's 2025, you're going to make money on that anyway. So I would say those guys aren't in any trouble. But if you're talking about a 5-year hold that you originated the loan in 2021 at a pretty high basis, I think at that point you'd have to do a cash
Decisions in front.
Yeah, you have a hard decision one way or another. So say you bought I see this a lot, deals that were bought in 2021, maybe it was a 2017, 2018, 2019 vintage, and say it's Charlotte or Atlanta or Raleigh, and they bought it for $340 a unit, right? Or $320 a unit. Let's say lower to mid 300s. And their in-place chunk rents today on that deal are like $1,600. And I see this deal, this profile all across the Southeast. That deal's not going to, I just don't see your basis going back above 300 on a deal like that next couple of years. So that deal is going to be a loser. How much of a loser, again, remains to be seen, but you're going to start to see groups have to realize some losses that they continue to carry, knowing that at some point or another, they're going to be forced to transact at a much lower price. And again, that's where you talk about pricing discovery and reestablishing a new price point for some of this stuff. Because again, you just saw so much frothiness in 2021 and 2022, and the groups are just holding on, waiting for a better day that really probably won't come. You're not going to see interest rates, the Fed fund rate, drop it back down to zero.
No.
The only reason they would do that is if we had a catastrophic recession. And then we got a whole different host.
Right.
Yeah, people need to understand, like, real estate at the end of the day had been pretty easy coming out of the GFC all the way up until COVID. You could buy a decent deal, ride the low interest rates, ride the net migration, the fundamentals, and make money. But it's typically not been the case. And at the end of the day, it's still a hard business to do well. And if you have a poorly timed buy or get caught up in the run up, as a lot of groups did, you're going to end up taking some losses. And eventually you're seeing that a little bit. And you'll see that a little bit more. Do I think it leads to a massive amount of distress? No, because again, I think the underlying fundamentals in the deal are strong enough. They're making enough cash flow to at least pay the debt service, I guess the best way to put it. They're not also doing any cash distributions, but yeah, I don't see any big distress there. But you will have some groups that have to take some losses, and it's all part of the game. That's a risk involved. Yeah.
I think on that note, we'll wrap it. Ryan, I appreciate you, and you'll have to be like a regular guest.
I love doing it. So yes, I enjoy coming on and talking business with you.
It's a great time. Always is. All right, man. Thank you so much, and I hope you have a great rest of your day.
Thanks, man.
All right. See you, Ryan.
Yeah.
That's it for the Stash Cast. Subscribe, share, and stay ahead in commercial real estate and prop tech. See you next time.